Hi there. Are you looking to buy stocks that fits your needs but you don't know where to start? Don't worry, I got you. In today's video, we'll be diving deep into Veva systems, breaking down the step-by-step process that you need to know for evaluating stocks through fundamental analysis and technical insights. This is gonna be a fast guide to making informed investment decisions. So let's get started. Hi guys, this is Chuck from the Assets Corner, and as I was saying, today we are going to get deep into what's the process that I follow when I know that there is a stock that I want to buy but I'm not sure. I usually take a look at the fundamentals and a little bit of technical analysis, and then I decide if that stock can fit in my portfolio. The guide that I'm gonna do today is a short version, so it's not that deep. It's something that you can do within, I don't know, 5 minutes in order to see if that stock that you think that is a fit is actually a fit. It is important to notice that this is not for going deep into seeing everything from the stock. It is just when you have like this kind of feeling, hey, this stock is probably something that I should buy, are like facts that will let you know if that's actually a stock that you should buy. So let's go into the computer. So here we are. As I said, today we are gonna take a look at the Veva systems. I hope that's how you pronounce the name. This is a stock that someone told me yesterday about, and it made a lot of sense. However, you know, like people usually they tell you, hey, you should buy this stock, and then the problem is you go and buy that stock without prior making your research. So first thing that I do when I hear about a stock is ask myself, do I know that stock? Could I have like a pitch of 2 minutes of that stock? And in the case of Veva systems, I can do it now, but of course I had to learn it at some point. So the first thing that you do is to go and find information about that stock. I can recommend Barrons because this is a site where they have been doing this for a long period of time. By the way, this is my Spanish name, and you don't have to subscribe. You have to register, but you don't have to pay for that. So when you are here, you can see down that there is this company and people information, and then you take a look at this. As it says, Veva engages in the provision of industry cloud solutions for global life science industry. This is important because although this company is in the healthcare sector, it is a cloud solution, meaning it is a tech company. You have to take a look at it as if we're a tech company. And that's something that Barrons does pretty well. It tells you, hey, this is the industry, it is software, and the sector is technology. However, as I said, this is based in the healthcare sector, and that's important to know. So when you already have an idea of what they do, the other page that I also recommend in order to get a look at it is Mornigstar.com. And I have this, which you usually don't have, this kind of analysis, because I pay for Mornigstar.com. You don't have to, because here down there is always this description, which is always for free, and then you see again that it says that it's a cloud-based software solution for life science industries, but it is in the healthcare sectors and the health information services. So as you see, it's different from what Barron said. Anyways, you take it as a tech stock in the healthcare industry. Second step is to know what they're selling. Then we see here, it says the company's best breed offerings address operating and regulatory requirements for customers ranging from small emerging biotechnology companies to departments of global pharmaceutical manufacturers. So he doesn't say what they sell, but they tell you that it's not just for one sector in the healthcare. It's not just for the small companies, but also for big companies. Then here we see what they do. They have a CRM, which is a customer relationship management platform like Salesforce, and it has Veva Vault, which is a content management platform that tackles various functions within any life science company. I also know they have cloud, and they sell R&D as a cloud service. So the second thing that we do is to find out what type of a stock is that. Not the industry, the sector, what they do and what they sell, but in terms of the stock. Is this a mid-cap stock? Is this a large-cap stock? And as well as the style of the stock. When we go here again, then we see that from Morningstar.com, it tells us that it's a mid-cap stock in the growth style. And when we know that it's a growth stock, which is a mid-cap or small large large cap stock. We know already what they do, what they sell, where they're located. The next step is to see how they are growing, right? Because it's a growth stock. In this case, the first thing that I take a look at are the earnings per share. Why? Because that's the money that I get for the shares that I have from that stock. And what I look at is for earnings per share growing pretty fast. I have two metrics for that. The first one is earnings per share in a quarterly basis. So I look at the last quarter that I have in the statistics and I compare it to the same quarter from the last year. This is important because it's not the previous quarter, but the same quarter from the last year. Reason for that is that way you can see how the stock is performing through different periods of times. And you cannot compare, for example, the fourth quarter to the third quarter, because it might depend on the customers and how they usually buy. Taking a look at the earnings per shares, I usually use TradingView. You don't have to use this. You can use Yahoo Finance, which is for free, but I have TradingView. I love TradingView. There is a free version of TradingView that you can use. I use it so much that I cannot have the free version. And then we see first that what I was saying in these quarters is that in this case, they have like a 95% increase from the last quarter that we have, January 23 to January 22. However, here is something that I don't like. And what I don't like is that in October from 21st and comparing it to October 22nd, they didn't grow that much. And then from July 21st to July 22nd, there was a decrease. So this is not great. This is telling you that the stock had some problems. However, due to the macroeconomics environments that we have right now, this doesn't surprise me. And it's at some point, it has to be like a feeling that you have, like this is something that it makes sense to me that happened in the last year. So I'm cool with that. However, I appreciate that they came this high. And then the second thing that I want to see is how are they doing in year after year. So the second thing is we take a look at the earnings per share, but this time per year. And what I'm looking here is I need to have an earnings per share that is growing at least 10% year after year. And then when we go here, we see that in 21, it grew to 22 and more than 10%. That's cool. Then we have from 22 to 23, also more than 10%. And then I look also the third year before. So from 20 to 21, it was also more than 10%. So on earnings per share, we can do the check mark. However, we should take a look at it next quarter. And then when we are taking a look at the stock reevaluating next quarter, this is something that we have in mind. When we know that the earnings per share are there, other things that we start doing are taking a look at the financials. Are they selling? Are they having net income after selling? How is the cash flow doing? How is the debt equity ratio? Do they have too much equity? And that way we can figure out how is the health of the company. Going back to Mornigstar.com, we have this financials tab here. We see that the first thing is that the revenue has been increasing year after year. And then also the net income is also increasing year after year. This tells to me that they are selling, and that's a good thing. So they are selling and they are, after the costs, they are still having profits and net income, and that's great. That's why you look in a company. I know that in the research R&D sector of the company, in this particular case, they have a little bit more growth than in the CRM part of the company. However, both part of the companies, they were growing pretty fast, so I'm cool with that. Second thing that I do within the financials is the cash flow. I never buy companies with a negative cash flow in the last 12 months. So I take a look at this and it tells me that the cash flow, the free cash flow is positive. So that's a thumb up. The third thing that we take a look at within the financial statements is the debt. Do they have too much debt or too little debt? And for me, the important thing is that the assets, they are growing, and here the debt is going down, which is amazing. And then we can see also that the total debt in millions in this year is 60 millions. However, we saw that the net income is 487, meaning they could pay the debt with the money they are having right now. This is amazing. This is outstanding. This is something that you want to have in a company. And then you see also that the free cash flow is higher than the debt they have, meaning if something happened, they could pay the whole debt, the whole liability, and they will still have money. The next thing that I usually take a look at are the quit ratio and the current ratio. If you want to know what is that, take a look at the description below, because I will put a link there for you to know what is the quick and and the current ratio. The quick ratio and the current ratio within Mornigstar.com is found here in the quote, and then you go down to the key statistics. You can find that in other platforms. I usually look for the current ratio higher than 1.5. Why is this? The current ratio are the current assets over the current liabilities. Meaning, if the company sells the assets, can they pay the liabilities? And how often? How many times? When you have 1 and 1, the result is 1, current ratio is 1. It means that with the current assets, they could pay the liabilities. If you have a current ratio which is smaller than 1, will mean that the liabilities, the debt, is higher than the assets the company has. Meaning, if they have to pay right now, they cannot do it. You have to be careful with that, for example, because if you go to companies like Apple, you will see that they have a lower current ratio. However, Apple is a company with a lot of money. In the case of Apple, with the iPhone, you usually buy an iPhone, Apple gets a liability. However, the iPhone is not done within days, but in a period of time. So you usually have to be a little bit careful about that. But as a rule of thumb, you should aim for current ratios that are higher than 1.5. Then the quick ratio is a more strict ratio than the current ratio. So if the quick ratio is higher than 1.5, that's even better. The other thing that I usually look is at the interest coverage, which tells you how if the company is able to pay the debt. However, here is not given, but with this quick ratio and that current ratio, we are okay. The next thing that I usually take a look at are the price over earnings. And this is bad. I usually look for a PE lower than 30 because those are the number of years that you need to pay the price with the earnings that you have. And this tells me that this stock is right now overpriced. However, in tech companies, that's a normal thing. This is too overpriced, to be honest. Like, this is not great. By 40 or something, it's okay. You just have to know that the price over earnings is the premium that you are paying for that particular stock. In the case of this stock, I'm fine with this bad PE because they have other things that I'm pretty interested in. And we are gonna take a look now at the price and the technical analysis to see and corroborate what we are saying. Let's jump into the technical analysis. For the technical analysis, I also use TradingView. Again, you can use it for free. So what are we looking at right now? And this is something that many people don't know. This is a graphic that I implement myself that tells me if the earnings per share are higher than the price. Meaning, if the earnings per share are higher than the price, it means that that company has room to go. Like, even if the PE is high, which tells us that it is overvalued, this graphic tells us that it's not that overvalued. I took this idea from a book, Once Up on Wall Street, from Lynch, and he wrote that in some page, and I really like it. And then I implemented myself here. Let me know in the comments if you want to have this script for that. I can give you for free. So we see here again that the earnings per share are higher than the price. That's telling us buy. Then we also have a little bit more of technical analysis. I won't get super deep into that. I just want to share with you that when you take a look at the monthly chart, we see that they are now going down. Meaning, even if the PE is that high, the stock is not that high. The stock is underperforming in terms of prices, but it has a good financial, good fundamentals. And that's the thing that I want you to learn today. Don't just focus on the price and what is on the chart. Take a look at the fundamentals, because eventually this will justify the price. This tells me right now that the stock is not performing well on the market, so it's time to buy because I have a discount. It is underperforming. So if we take a look at the daily, then we will see that it is already to buy. And this is another script that I built, and this tells me, hey, when to buy and when to sell. Pretty easy. I don't sell that often. It's just more for buy signals. If the day signal tells me it's a sell, I wouldn't buy today. I will wait a couple of weeks. But as long as it is a buy in the day, I can buy. And that's it. That's what I actually look at the technical analysis. You shouldn't get too crazy with the technical analysis because that is so much that you can do with that. And I'm aiming for a long-term investment. And that's the important thing. Why is fundamental more important than the price? Because when I invest, I hold for at least 5 years. Meaning, I don't care what's the price today. I care what is the price in 10 years. And then when we go back to that PE of 60, is justifying that in 5 years, this is something that that it's gonna be worth. And with those fundamentals, with those financials, with the earnings per share higher than the price, and with that bunch of money there, with the need that we have on the healthcare sector and the need of companies of building new medicines and the advantage that this company brings into that market, as today, this is a company that I will buy today. And that's it for today. I hope that you learned something and I hope that this helps you. Please, this is a disclaimer. I'm not telling you to go and buy this company. You actually should do your research by yourself. I just wanted to show you how is my process, my quick process to see, hey, do I want to buy this company or not? Even if this video took a little bit longer, usually I can do that within like 5-10 minutes, and then I have an overview pretty quick if this is a company I want to buy or not. There is of course the work that I did prior in order to know what is the company, where that it's selling, what is this company that is gonna be there in 10 years, is this a company that is gonna be out of the market like soon? And since that's not the case, then I will go for it today. If you like the content so far, don't forget to subscribe, like, and activate the notification button, and as well as share. If you have a friend who might be interested and who can benefit from this, please share with that person. And without anything more, as I always say, never give up and try to be the best version of yourself. Check out.